Hi, this is G-Man Trading Community, and today, my friend, we said that we will dive deeper into CFD trading. We'll know the history of CFD, how it was started, and where it came from. Because as we learned from our previous lessons about investing, we saw that investing was as simple as straightforward how we do business with each other in the streets or everywhere else. But now the difference was that it came even into on to the digital space. So we'll see now the second model of trading, which is CFD, which was introduced, and we'll see why was it introduced, and it has some particular systems which are there for it to be very functional and to be very reliable. So in these are introduced system. So this is a little bit controversial, but I'll try my level best to explain deeper and very simple and straightforward on how we can interact with CFD trading. So let's dive in. CFD is equals to contract for difference, like we have been always been saying, contract for difference. And the next thing is, here is the clear simple origin story of contract for difference, where CFD started. CFD were invented in London in the early 1990s by two bankers at UBS Warburg, Brian Callan and John Woods. Those are the two people who introduced CFD trading. So you can see now, you will see where the system lies on CFD and how the same system is being used even today into the financial industry. But you could see now there is these two bankers who introduced CFD trading, and we'll see how they used it and why. So they were created. They created CFD for hedge funds so they could trade stock with leverage, avoid paying UK stamp tax, because now you don't interact with the real asset. So a tax on buying or actual share. So when you are buying actual share, you pay brokers charges and you pay tax. But now in CFD you don't have that, and it is very even hectic even for execution. We learn it here. So take long to short position easily. So you can see, take long or short position easily. It will be it helps so much when you are even taking any kind of position. Another thing is that you could trade large volume without physically owning the share. You trade large volume of shares without owning them. So that's why it was so much important. At that time, hedge funds needed a tool that allowed something like faster execution. Let's go to the next. Another thing is low capital requirement, then the ability to short sell without borrowing shares. So CFD solved all that. So the hedge funds needed those three things, which was low capital requirement, ability to short sell without borrowing shares, and faster execution. So, and CFD literally solved that, because they introduced a system would help them to do that. So let's go on. How they spread globally. First, used mainly in UK financial market. This is how the CFD spread. And then in early 2000s, broker brought CFD to retail traders, all ordinary people like me and you. So this was the early 2000s. And then they expanded into forex, commodities, indices, crypto, and equities. So these all assets were able to be traded through CFD because it was simple. You don't interact with the real asset, because when it comes to commodity, there's regulations, a lot of regulation. When it comes to indices, the same as that. When it comes to crypto and equity, so and all these assets, like we learned from in the investing forum, like in the investing model, all these, they have their own way of interacting with them, different brokers, a lot of things which were needed for for people to access them. But with the CFD, now you need one broker, because the system is simple. All you need is to speculate the market direction. So today CFD trading is very common in Europe, Asia and Africa. So why CFD became popular? Easy to trade, price movement without owning the asset, a very low capital needed, that's high leverage that was offered by the brokers, which now help us into interacting with this model of trading. Now they offered leverage. We'll learn about this as we go on. So how you can trade rising and falling markets, you can trade them, but in the real world you can't trade a falling market. How can you profit from a falling asset? You can't trade a falling asset in the real world, but in CFD you can speculate the market would fall and you pick that direction, and the amount of space that will be between your opening position and the asset depreciation, then that's what you'll be paid when it is multiplied by the contract that you bought. How many contracts did you buy? So we'll go deeper and we'll learn all that. Let's go to the next page. But the game changed when the system of CFD it came to banks after the collapse of the Bretton Woods system in 1971. Now take this into your mind. This is where now the game of CFD changed. The game changed when the banks took this system after the Bretton Woods system collapsed in 1971, where currencies were fixed to the US dollars, meaning in Euro USD, for example, rate is $2. There's no sense like 2.1234. It wasn't like that. It was a fixed rate, which was, if it is $2 final, nothing else. But now after the Bretton Woods system collapsed in 1971, now the currencies could fluctuate freely. So after the collapse, currencies were allowed to float freely with even cents. Yeah, so currencies were even allowed to float with even cents after the break of Bretton Woods. So now banks, they need a system to be able to track down even this small movement, and we'll learn about that as we go on. So big banks started speculating the price movements. The forex became a global market. A bank and financial institutions started trading only the exchange rate differences. You can see now how it opened opportunities. And later there is something else had to happen, because even after the Bretton Woods system collapsed, the currencies didn't move that much, because every country is protecting its currency to stabilize when buying goods worldwide. So even after the collapse, and the market is moving even with these cents or floating freely, so those currencies, they were not even moving so fast, because every country is protecting its currency when it comes to buying. Because if you have an inflated currency, then you'll have to pay more when you are buying outside the country, so outside your country. So we'll go deeper and we'll learn a lot of things. So now, as the exchange rate began to move freely, bank needed a standard way to measure forex movement in exchange rates. So forex movement needed to be measured in the exchange rates. So and that would persist. Now they will come as this is a problem, and they need a way of solving it. So they also needed a standard way to measure how much money it would be traded. So now they even introduce, it's like you have a shop, for example, and you are selling, you are a wholesaler, so you would set a standard amount of, maybe you are selling eggs, you'd set a standard amount of eggs that you would sell in wholesale. So you would not accept someone to come and buy one single egg and buy with a wholesale price, but you would say, if you come and buy 5 trays of egg, I will sell you at this particular price, at a wholesale price. So the bank needed set a standard way of measuring amount of money to be bought or sold or being traded in the market, and a standard way to measure forex movement in the exchange rate. So let's go on. In the word CFD, in money there will be a little difference in explanation now. So C would start, which is contract for, refers to amount, and D difference, which refers to distance. So you can now see, so it is contract for difference, but now C, which is contract, refers to amount now, and the D, which is difference, refers to distance. So in money or forex, now bank said amount will be moved in the market will be in lots. So now that's, we have now another word which has persisted, and lots will stand for C, which is contract, because when people were buying shares in those 1970s and 90s, in the introduction of CFD in the industry of financial market, which came through buying shares, like we learned in this history of CFD, contract shares were bought in contracts. So one contract would stand for 2,000 shares. So if you have 2 contracts, you are talking about 4,000 shares. So the word contract is representing amount. So one contract in shares was representing 2,000 shares. So the word lots now, it will have to represent amount of money. It will have now to represent amount of money, because we are in money now. This system has been taken by banks, as we have been learning. So now the banks said amount to be moved in the market will be in lots, and in the distance will be measured with pips. Now another word which will come for the difference. So this system was introduced by stock market, but now to come to banks, now we have to change. Now we don't need contract, we need lots. So the amount will be represented by lots, and one lot will see how much it will represent, one single lot, and the pip now will be used to measure difference from opening position, the opening price minus by the closing price, and then it will be measured in pips, and you will see pip value, pip differences. We will learn all that. So let's go on. So in this course of ours, the best thing is whatever question pops out will be diving in it. So as we have been going, there have been some upcoming words which will lead to lessons. So as we have learned about history of CFD, now we have learned the history. It was started by stock market, then it came later after the Bretton Woods collapse, and then it was took by banks. They needed a way to measure the price difference, and then even to set an amount of money that would be bought in the market. So, and it has introduced us to something called lots and pip, and that's what we are going to look after as we go on. every word that pops out in the market, it will lead to a lesson so that everyone can learn, because it is now we are joining our puzzles, we are joining parts, so that at the end of the day we will come up with a very very solid knowledge on CFD trading. Because I said this is not a walk in the park. When it comes to CFD, it's a very 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 hard course and very very complicated one, but you will learn it in this channel. So now we are going to the first question that popped out in our mind: what is lots and pips? Like I have said, we will start with the lots, and stay tuned. So, and there is a sticker here talks about contract for difference. A contract for difference is a financial derivative product that enables trader to have exposure to the price movement and the underlying asset of an underlying asset, such as stocks, and without owning the asset itself. Now that's the main logic of CFD trading. Now we have now something else to look at, because now the reason this system came to banks, the banks will change everything when it comes to CFD trading. And the next lesson is here with us, so let's go. Thank you very much, and consider subscribing.